Let me be very clear from the start. What we just witnessed in the silver market was not random, and it was not emotional selling by small investors. It was engineered. Markets don't move violently without powerful forces behind them. And when prices fall sharply while fundamentals remain intact, you should always ask one question: who benefits? Silver is not just a metal, it is money, it is industrial necessity, and it is a strategic asset. When you understand that, the recent crash starts to make sense. When people look at a sharp fall in silver prices, the natural reaction is to assume fear, bad news, or a sudden collapse in demand. But markets at this scale don't move like that by accident. A move of this magnitude requires structure, leverage, and coordination within the financial system. What we saw in silver was not a spontaneous emotional reaction by millions of small investors. It was the result of how modern markets are built. Silver today is largely traded through paper markets, especially futures and derivatives. These markets allow participants to control large amounts of silver with relatively small amounts of capital. That leverage works both ways. When prices move against heavily positioned traders, margin calls are triggered. Those margin calls force selling, regardless of whether the trader believes in silver's long-term value or not. Once that process starts, it feeds on itself. Before the crash, silver futures were crowded. Too many participants were positioned on the same side of the trade, expecting higher prices. When liquidity tightened and pressure appeared, large players reduced risk. That reduction didn't happen gently. It happened quickly and at size. As those positions were unwound, prices dropped sharply, which triggered more margin calls, which forced even more selling. This is not emotion, it's mechanics. At the same time, narrative plays an important role. When price falls fast, the story follows the move. Headlines shift from optimism to panic. Words like collapse and breakdown dominate the conversation. That narrative amplifies fear among retail investors, pushing them to sell into weakness. But narratives usually trail price action. They don't cause it. By the time the story reaches the public, the structural move is already well underway. It's also important to understand who controls liquidity during these moments. Large institutions, market makers, and funds with deep balance sheets are able to withstand volatility. Smaller participants cannot. When volatility spikes, the system naturally transfers positions from weak hands to strong hands. That transfer is not conspiracy. It is how leveraged markets function. Calling this crash engineered does not mean there was a single mastermind pushing a button. It means the market structure itself, combined with positioning and leverage, created a predictable outcome. When leverage is high and liquidity dries up, price will move violently. Those who understand this can anticipate where stress will appear and position accordingly. Another key factor is the separation between paper silver and physical silver. While paper prices were falling aggressively, physical demand did not disappear. In many cases, it strengthened. Premiums remained firm, inventories stayed tight, and long-term demand drivers did not change. That divergence is a signal. When paper price disconnects from physical reality, it usually doesn't last forever. Retail investors often ask, why would anyone push prices down? The answer is simple. Lower prices allow large players to reduce risk, rebalance exposure, and accumulate assets at more favorable levels. Markets reward patience and preparation, not reaction. So when you step back and remove emotion from the picture, the silver crash looks less like chaos and more like a controlled release of pressure. Leverage was flushed out, weak hands were forced to sell, and price moved to a level where stronger buyers could step in. This is how markets have always worked. The mechanism changes, the assets change, but the pattern stays the same. Those who understand structure survive volatility. Those who don't experience it as shock. One of the biggest mistakes investors make is believing that price always reflects reality. In the short term, price is often the least reliable indicator of truth. It is shaped by liquidity, leverage, positioning, and emotion far more than by fundamentals. This is especially true in markets like silver, where paper trading volumes dwarf the physical market. Short-term price movements are driven by who needs to buy or sell right now. If a leveraged trader is forced to sell because of a margin call, the reason has nothing to do with whether silver is valuable or not. It has everything to do with risk limits and survival. When many participants face the same pressure at the same time, prices can move sharply in ways that appear irrational to long-term observers. Fundamentals operate on a very different timeline. Supply does not change overnight. Demand from industry, technology, and monetary hedging develops over years, not days. Mining output cannot be turned on and off like a switch. These realities move slowly, but they are what ultimately determine value. When price detaches from these fundamentals, it creates distortion, not truth. Financial markets are reflexive. When price goes up, confidence rises, leverage increases, and narratives turn positive. When price goes down, confidence collapses, leverage is reduced, and narratives turn negative. This feedback loop exaggerates both highs and lows. In the short term, price becomes a reflection of psychology rather than reality. Silver is particularly vulnerable to this effect because it is traded as both a commodity and a monetary asset. When macro conditions shift, interest rates, dollar strength, or liquidity, silver often reacts sharply even if nothing has changed in its underlying use or scarcity. Traders respond to signals, not substance. Long-term truth, however, has a way of asserting itself. When prices remain below the cost of production for extended periods, supply eventually tightens. When strategic demand grows from energy transition, technology, or geopolitical uncertainty, consumption increases regardless of price volatility. These forces do not show up immediately in charts, but they shape the future. History shows this pattern repeatedly. Assets that are overvalued can stay expensive longer than people expect, and assets that are undervalued can stay cheap longer than seems reasonable. But eventually value and price converge. The challenge for investors is surviving the gap between the two. This is where patience becomes an advantage. Investors who focus only on price signals are constantly reacting. Investors who focus on fundamentals and probability are positioning. They accept that timing is uncertain, but direction is clearer. They understand that temporary mispricing is not a threat. It is an opportunity. Another important distinction is between volatility and risk. Volatility is visible. It is noisy and uncomfortable. Risk is often invisible. It lies in overconfidence, excessive leverage, and lack of understanding. An investor who understands why they own an asset is less likely to be shaken out by short-term price movements. When silver prices fall while fundamentals remain intact, the correct response is not panic, but analysis. Ask what has actually changed. Has supply suddenly surged? Has industrial demand collapsed? Has silver lost its role as a monetary hedge? If the answer is no, then price is telling you more about the market's current stress than about silver's true value. In the end, price is a messenger, not a judge. In the short term, it delivers emotion and imbalance. In the long term, it delivers truth. Successful investing is about knowing the difference and acting accordingly. When leverage builds up in any market, it creates fragility. Everything appears stable on the surface, but beneath it sits pressure waiting for a trigger. In silver, that pressure had been building quietly. Futures positions were crowded, speculative exposure was high, and many participants were depending on continued price stability to maintain their positions. When that stability broke, the selling that followed was not a choice, it was a requirement. Forced selling is one of the most misunderstood dynamics in financial markets. Investors often assume that selling means someone has changed their opinion. In reality, most selling during sharp declines has no thing to do with belief. It is mechanical. Margin calls force traders to reduce exposure immediately. Risk managers demand lower leverage. Funds hit stop levels written into their systems. None of this is emotional, but all of it creates powerful downward pressure on price. As prices began to fall, liquidity thinned. Buyers stepped back, waiting for stability. Sellers, on the other hand, had no such luxury. They had deadlines. The result was imbalance. Too many sellers, not enough buyers. This is when markets fall faster than logic would suggest. The absence of bids matters more than the presence of bad news. This type of selling creates a very specific opportunity, when assets are sold because they must be sold, rather than because they are fundamentally weak. Price becomes temporarily distorted. Value does not disappear, but price does. For investors with capital, patience, and no leverage, this is when opportunity emerges. Historically, the best entry points occurred during periods of forced liquidation. In 2008, quality assets were sold to meet margin requirements. In 2020, even safe assets were liquidated to raise cash. Each time, those who understood the difference between liquidity stress and fundamental deterioration were able to act decisively. In silver, the same pattern played out. As leverage positions were flushed out, price fell below levels justified by long-term supply and demand. This did not mean silver suddenly became less useful or less scarce. It meant that the market needed to rebalance. The key advantage of strong buyers is flexibility. They are not constrained by margin calls. They are not judged on daily price moves. They can wait, scale in, absorb volatility. When panic selling peaks, they provide liquidity quietly and selectively. This is why opportunities rarely feel comfortable. By the time an opportunity looks obvious, price has already adjusted. True opportunities appear when uncertainty is high and confidence is low. The discomfort is not a flaw, it is a signal. Retail investors often sell during these moments because they feel they must act. Institutional buyers act because they are prepared. Preparation, not prediction, is what separates the two. Another important element is time horizon. Forced selling is a short-term event. It resolves itself once leverage is removed. Value, on the other hand, compounds over long periods. When these two timelines collide, the long-term investor gains an edge. In silver's case, the forced selling phase reduced excess speculation and reset the market. That reset is healthy, even if it feels painful. Markets cannot move higher sustainably while leverage continues to build unchecked. So when you see sharp declines driven by liquidation, the right question is not what went wrong, but what was forced out. Once weak positions are cleared, markets become more stable and more reflective of reality. Opportunity does not announce itself. It arrives quietly, wrapped in fear and confusion. Those who recognize forced selling for what it is, a temporary imbalance, are the ones positioned to benefit when stability returns. One of the clearest differences between experienced investors and reactive participants is how they process information. Most people look to headlines, social media, and price action for guidance. When the tone turns negative, they assume danger. When it turns positive, they assume safety. Large long-term investors operate in the opposite direction. They understand that public narratives are usually late and often wrong. Headlines are designed to explain price after it has already moved. They simplify complex market dynamics into emotional stories that are easy to consume. During a silver crash, the narrative quickly becomes about failure, manipulation, or the end of a cycle. These stories spread rapidly because fear spreads faster than nuance. By the time the average investor reacts, the price damage is already done. Institutions do not build strategies around headlines. They build frameworks. They ask whether an asset is cheap or expensive relative to history, replacement cost, and future demand. They examine positioning, liquidity, and stress in the system. When price collapses but these measures improve, attention increases rather than disappears. Another key difference is access. Large investors have access to data that retail investors rarely monitor: inventory flows, physical demand signals, leasing rates, and delivery pressures. They watch what happens when price falls, not what commentators say about it. If physical buying remains steady or strengthens during a paper sell-off, that divergence matters. This is why accumulation is often invisible. Institutions do not announce their buying intentions. They scale in gradually to avoid moving the market against themselves. They prefer periods of low liquidity and negative sentiment because it allows them to buy without competition. Silence is part of the strategy. Retail investors, on the other hand, are often conditioned to seek confirmation. They will and to buy when price is rising and news is positive. Unfortunately, that is usually when risk is highest. When everyone agrees, there is little margin for error. The silver market has seen this pattern repeatedly. Periods of pessimism coincide with quiet accumulation. Periods of excitement coincide with distribution. This cycle is not driven by emotion alone, but by structure. Large players think in probabilities and portfolios, not in predictions and single trades. Another reason institutions ignore headlines is time horizon. A pension fund or sovereign entity is not concerned with next week's price. It is concerned with preserving purchasing power over decades. In a world of rising debt and currency pressure, real assets play a strategic role. Short-term volatility does not invalidate that role. There is also a psychological advantage in being early. Buying when sentiment is negative requires conviction and patience. It allows investors to size positions properly and manage risk calmly. Chasing price higher requires speed and precision, leaving little room for error. Importantly, ignoring headlines does not mean ignoring risk. It means assessing risk differently. Institutions reduce risk by diversification, position sizing, and time, not by reacting to noise. They accept uncertainty as part of the process. For the individual investor, the lesson is not to copy institutions blindly, but to adopt their mindset. Instead of asking, "What is the news saying?" ask, "What is the market already pricing in?" Instead of reacting to fear, analyze whether fear is justified. When silver is declared finished, when interest fades, and when narratives turn hostile, that is off T. And when the most disciplined buyers pay attention. They are not trying to be heroes. They are simply following a process that has worked across cycles. In the end, markets reward those who think independently and patiently. Headlines may shape mood, but they do not shape value. Those who understand this are less likely to sell at the wrong time and more likely to be positioned when the narrative eventually changes. Silver occupies a rare position in the global system because it is both a monetary metal and an essential industrial input. Very few assets serve these two roles at the same time. This dual nature gives silver strategic importance that is often overlooked when price action dominates the conversation. While short-term traders focus on charts and momentum, long-term demand quietly continues to build beneath the surface. From a monetary perspective, silver has been used as money for thousands of years. That history matters, not because the world will suddenly return to a silver standard, but because trust in metals tends to rise when trust in paper currencies weakens. In environments of rising debt, persistent deficits, and currency debasement, tangible stores of value regain relevance. Silver benefits from this dynamic, even if it does so less visibly than gold. At the same time, silver is indispensable to modern industry. It is one of the best electrical and thermal conductors known. This makes it critical for electronics, solar panels, electric vehicles, medical equipment, and defense technologies. As the global economy becomes more electrified and digitized, silver demand becomes structural rather than optional. These are not trends that reverse easily or quickly. The energy transition is a key driver. Solar power relies heavily on silver for photovoltaic cells. Even with efficiency improvements, total silver usage has continued to grow because deployment has expanded so rapidly. Governments around the world are committing capital to renewable energy infrastructure, creating long-term demand visibility that is largely independent of short-term price fluctuations. On the supply side, silver faces constraints that are often underestimated. Most silver is produced as a byproduct of mining for other metals, such as copper, lead, and zinc. This means supply does not respond directly to silver prices. Even if silver prices rise, production cannot be increased quickly unless it aligns with the economics of other metals. This creates rigidity in supply. Additionally, high-quality new silver deposits are becoming harder to find. Mining is capital-intensive, politically complex, and environmentally regulated. Projects take years, sometimes decades, to move from discovery to production. When prices remain depressed, investment in new supply declines, setting the stage for future shortages. This combination of growing demand and constrained supply forms a powerful long-term foundation. It does not guarantee immediate price appreciation, but it increases the probability of higher prices over time. Markets can ignore these realities for extended periods, but they cannot erase them. Strategic buyers understand this. They do not expect silver to move in a straight line. They view volatility as noise within a larger trend. When prices fall sharply without a corresponding change in these fundamentals, it signals mispricing rather than deterioration. Another important element is inventory. Available above-ground silver inventories are relatively small compared to annual demand. This means that even modest increases in investment or industrial usage can strain supply. When that happens, price adjustments tend to be rapid rather than gradual. Silver's role in defense and technology also adds a geopolitical dimension. As supply chains fragment and nations prioritize strategic resources, metals with critical applications gain importance. Silver's conductivity and reliability make it difficult to substitute at scale, reinforcing its strategic value. In this context, short-term price suppression does not change the underlying equation. It delays recognition. Eventually, markets must reconcile price with reality. When they do, the adjustment often catches participants off guard. For investors, the key is alignment. Owning assets that align with long-term structural forces increases the chance of favorable outcomes. Silver's combination of monetary relevance, industrial necessity, and supply constraints places it firmly in that category. Price will fluctuate, sentiment will swing, but the strategic role of silver remains intact. And in markets, it is often the assets with the strongest foundations that endure the longest periods of misunderstanding before being repriced. Many investors confuse volatility with danger. They see sharp price swings and assume something is wrong. In reality, volatility is a natural feature of markets, especially in assets that are thinly traded, leveraged, or emotionally charged. Risk, however, is something entirely different. Risk is not knowing what you own, why you own it, or how it fits into your broader strategy. Volatility is visible. It shows up on charts and in headlines. It feels uncomfortable because it challenges our expectations and tests our patience. Risk is often invisible. It builds quietly through excessive leverage, poor diversification, and decisions driven by fear or overconfidence. The most damaging losses usually come not from volatility itself, but from reacting to it incorrectly. Silver is a good example of this distinction. Its price history is volatile, but that volatility does not automatically make it dangerous. What makes silver risky for some investors is misunderstanding its role. If someone buys silver expecting quick profits or smooth price appreciation, volatility becomes a problem. If someone buys silver as a long-term hedge or strategic asset, volatility becomes something to manage rather than fear. Understanding transforms experience. An investor who knows the drivers of silver demand, supply constraints, and market structure is less likely to panic during drawdowns. They recognize that price swings are part of the process, not evidence of failure. This understanding reduces emotional decision-making, which is one of the greatest sources of real risk. Another source of risk is leverage. Leverage magnifies both gains and losses, but more importantly, it removes time from the equation. Leveraged investors do not get to wait. When prices move against them, they are forced to act. This is why leveraged participants often sell at the worst possible moments. The risk was not silver, it was the leverage. Long-term investors reduce risk by extending their time horizon. Time allows fundamentals to assert themselves, LVs. It also allows volatility to average out. Over longer periods, the probability of outcomes narrows and the impact of short-term noise diminishes. This does not eliminate uncertainty, but it improves decision quality. Position sizing is another critical factor. Even the best ideas can produce poor outcomes if they are too large. Concentration increases emotional stress and reduces flexibility. Proper sizing allows investors to hold through volatility without compromising their financial or psychological stability. Diversification also plays a role. Silver should not be viewed in isolation. Its behavior makes more sense when seen as part of a portfolio. It often performs differently from financial assets, which is precisely why it can reduce overall portfolio risk despite being volatile on its own. Education is a form of risk management. The more an investor understands the structure of markets, the less surprising market behavior becomes. Surprises create fear. Familiarity creates perspective. This is why experienced investors appear calm during turmoil, not because they are indifferent, but because they have seen similar patterns before. The irony is that attempts to avoid volatility often increase risk. Selling after a sharp decline locks in losses. Chasing assets after strong rallies exposes investors to reversals. A disciplined approach accepts volatility as the price paid for long-term returns. In silver, as in many assets, the biggest danger is not price movement, but misalignment between expectations and reality. When expectations are realistic and grounded in fundamentals, volatility becomes tolerable. When expectations are driven by hope or hype, volatility becomes destructive. In the end, successful investing is less about predicting markets and more about understanding oneself. Knowing your time horizon, risk tolerance, and objectives matters more than any forecast. Volatility will come and go. Understanding endures.